This is the spectacular crash of a $30 billion property empire. And it, it goes into the, well, I'm just going to read it. This is from the Wall Street Journal. Despite a criminal conviction, Rene Benko tapped into family dynasties and sovereign wealth funds to raise billions for Signa and a stake in Chrysler Building. Now, I don't want to kind of rehash the '08 crash, but part of the similarities are eerie because part of what happened in '08 as well is you had a lot of wealthy people, of family wealth, generational wealth, get into the subprime mortgage lending business, thinking that they would be able to ride this thing out forever, and it got so bad that one of the money managers for one of the richer families committed suicide after the whole thing. Um, so it was actually I might be getting that wrong. That might be with Bernie Madoff. I'll have to double check that. But believe me, there were people who not only were bankrupt, but they took their own lives over how dangerous this whole thing ended up being, and how people went sideways on this deal. But anyway, so this is from the Wall Street Journal. It's by Elliot Brown, Margot Patrick, and Conrad Pulitzer, and it's dated February 8th, 2024. So that was just last week. And it goes, Rene Benko was a high school dropout and convicted criminal, but by 2018, he was at the pinnacle of global real estate. His company, Signa Holdings, launched a glassy J-shaped skyscraper on the banks of the River Elbe in Hamburg, Germany. The design of the 800-foot tower resembled a chart showing exponential growth. Hamburg's mayor, the future German Chancellor Olaf Scholz, lauded Signa's good reputation with banks when the city picked the developer to build the tower. Signa is significantly strong, he said. It wasn't. Banco's sprawling $30 billion empire of trophy real estate and department stores has imploded into the biggest property bankruptcy in Europe since the global financial crisis. The mess threatens to unleash significant losses on scores of lenders and investors and freeze half built developments in numerous city centers. Stakes in Manhattan's Chrysler Building, upscale British retailer says, Siegfried's, no, that's Selfrid's, and sporting goods groups in US and Europe face the block. Auctioneers are selling off Signa's bookshelves, doormats, 700 bottle wine collection, and a diamond shaped award for Europe's 2021 Real Estate Brand of the Year. The Hamburg Tower is halted, leaving a 330-foot tall concrete stump. That's the picture that you saw in the beginning. The unrivaled marks The unraveling marks a dramatic reversal for the self-made entrepreneur who once lavished with backers with hops on his yacht, a top-of-the-line Bombardier Global Express jet, and trips to Signa's multiple Austrian hunting grounds, complete with a shooting guide for the company payroll. Left tallying their losses are heirs to the Tetra Pak, Puget family fortune, billionaire Ron Burke, and marquee sovereign wealth funds from Singapore, Saudi Arabia, and the United Arab Emirates. Dozens of banks lent mummies, including Citigroup and Swiss bank Hule Beer, whose chief executive resigned on February 1st after the bank wrote off 700 million dollars in loans tied to Signa. So that is just the beginning of this contagion, right? So we've got this issue in Europe, in Hamburg, Germany, and notice how at the end who's involved in this, as well as the real estate mogul, is banks and private wealth funds, right? These are two areas where you would normally uh, uh, get capital. You would be looking for capital from banks, and you would be looking for capital from sovereign wealth funds, from private investment, private equity, and that kind of thing. Now, I normally wouldn't give a rat's ass about the fact that a bunch of rich people lost their shirts on a bad deal. But there is more going on here, and we'll see that in just a minute. But now, going back to the second data point, which is what I discussed about 2 weeks ago on this, and that is the Evergrande, which is the huge real estate business in China that has been asked to liquidate. More information on that now. Western hedge funds that saw a killing in billions of Evergrande bonds stunned when the government handed out 99% haircut instead. And this is from Fortune's website by Alice Huang, Dorothy Ma, and Pearl Louis. This is also from Bloomberg, dated February 8th, 2024. From afar, China Evergrande Group had all the makings of a killer distressed debt trade. 19 billion in devalued offshore bonds, 224 billion in assets, and a government that appeared determined to prop up the country's faltering property market. So US and European hedge funds piled into the debt, envisioning big payouts to juice their returns. What they got instead over the course of the next 2 years is a harsh lesson in the dangers of trying to bargain with the Communist Party. The talks are now dead. A Hong Kong court has ordered Evergrande's liquidation, and the bonds are nearly worthless, trading in secondary market at just 1 cent on the dollar. While global money managers have long known that the Chinese government exerts influence over corporate affairs in ways that are uncommon across the developed world, Evergrande was nonetheless a first hand education for many of them in just how much authorities will intervene for the sake of political and economic expediency. The 1 cent on the dollar piece of the bonds, they say, sends a warning to investors as other Chinese companies, including Country Garden Holdings, follow Evergrande into default amid an economic slump that officials have struggled to fix. And the country's disregard for foreign creditors almost certainly means more of them will get sold for parts. So that's the next thing. So you've got now in Evergrande in China. First we're in Europe, Hamburg, Germany. We've got now in China. You've got Evergrande, where um, investors, banks, are taking a bath because the government of Singapore and the government of China has decided it is not going to backstop these losses, which you would think would be something
Yes,
that
I do
you
live.
would want to do if you wanted to prevent a huge problem in the economy, because you don't want to have banks going insolvent, which is the big threat here, right? So you've got commercial real estate. You've got these big, and I'm not talking about millions. We're talking about billion-dollar commercial real estate companies. They're going under. They're falling apart, and the banks that loan them their monies are also having to now write those debts off to the billions. And some of these banks are not capitalized properly, and are not capitalized enough to afford that. So you're going to start seeing banks going insolvent. This is my third data point, and this is from a hearing, just a couple of, I think this was just last week. This is Janet Yellen, the Treasury Secretary, on Capitol Hill, talking about concerns in the commercial real estate.
Concern about commercial real estate. We discuss it in the FSOC annual report, and FSOC has been quite focused on it. Um, the banking supervisors have also been focused on commercial real estate and are working closely with the banks they supervise to discuss ways to manage and work with borrowers who have problems. They're, in some cases, working to make sure that loan loss reserves are built up to cover losses, that dividend policies are appropriate, that liquidity is adequate. So the higher interest rate environment, and in some cases, particularly the case of office building, shifts in work patterns due to the pandemic, coupled with many commercial real estate loans coming due and needing to be refinanced in a context where vacancy rates in some cities are quite high, um, is going to put a lot of stress on the owners of these properties. And so the banking agencies are very focused in helping the banks manage through these situations.
So you're concerned but not distressed. Is that,
Yes, I mean, I'm concerned. I believe it's manageable, although there may be some institutions that are quite stressed by this problem.
So there you go. Concerned, but not too concerned. I mean that is what you would say, right? If you were the Treasury Secretary, you would say that you are concerned but monitoring these things carefully, and but let's be clear, and I really want to drive home this point, is that what happens in one sector affects others, right? This is a system that is tied together. And as one sector begins to degrade, it brings down other sectors, primarily the banking sector. So when you have real estate, commercial real estate, and we don't go into it here, I think every sort of country, every sort of incident may have its own unique situations. I think in Germany, there's sort of an implication where there might be a little bit of fraud going on there. In Evergrande, in China, there might be a situation where there was an attempt to prop up, the government tried to prop up their own economy by building. Here in the U.S., it's about a change in the way business is being done. Businesses, particularly in places like New York, where it's very expensive to have office space, people are not going back. They're walking away from their leases because folks are not coming into work. And it's easier now with the technology to just pay people remotely to do their work and not actually have to go in and pay that rent, pay that overhead. So each situation is different, but overall the theme is still the same. Commercial real estate is having a problem. And many commercial real estate businesses. WeWork, by the way, was one of them. Although WeWork is sort of making a comeback, but every one of these situations, there is a chance that these businesses will go under. And if they go under, the banking system that spent money on these loans are going to be distressed, and they may go under. And part of what's going on here is last year, we came very close to having a banking crisis, and the only reason why we didn't is because of Dodd-Frank. And the only reason why it won't be as severe as '08, if we do have a full-on crisis, is Dodd-Frank. Why do I say that? It's because there were certain things that will prevent bigger banks from becoming insolvent and nobody noticing it, right? In '08, the big problem is that these banks had sort of ballooned all this debt and nobody was paying attention. Now, through Dodd-Frank, thank you, President Obama, you've got this requirement for these banks to be stress tested. They have to show they've got the money in their bank should loans go belly up. However, there was a change during the Trump administration that allowed smaller and regional banks to be able to not have to be stress tested. Well, what happened last year is those banks turned out to be not properly collateralized, and they went under. Signature Bank, Silicon Valley Bank, these banks were not able to deal with a run on their banks, and when people got wind that there was a problem in the banking industry, what happens? You run to your bank and you try to pull out all your money, and that is a quote unquote run on the bank. And when that happens, banks who are not properly collateralized because they have their money elsewhere, they have to shut the doors on people, and that causes a panic within the banking industry, and other smaller banks begin to start to falter. People start just to be safe, they go to their bank, their regional bank, and they pull out the bulk of their money. So the contagion is in part the fear, whether it's true or not, that your bank may be not properly collateralized, not have your money, and that fear drives a run on banks. And banks that are not really properly collateralized, they don't really have the money sitting there in the bank, they start to buckle. Case in point here, this story out of the New York Times, February 7th, which goes into, and it is entitled, "The Real Estate Crisis Looming Over Banks." A year after the collapse of Silicon Valley Bank, investors are fearing for regional lenders saddled with a mountain of souring commercial mortgages. This is by Andrew Ross Sorkin, Avi Matu, Bernard Warner, Sarah Kessler, Michael de la Merced, Lauren Hitch, and Ephrat Livin. I'm sorry if I'm butchering these names, but New York Times, again, all of these articles, all of these stories that I am discussing with you will be in Mastodon. You can check it out, mastodon.vtip.me/at what you missed. So anyway, going back to the article, the sell-off in regional bank stocks looks set to worsen on last week Wednesday, after Moody's cut New York Community Bancorp's credit rating to junk status. Fears are now rising among investors over the United States' distressed commercial real estate sector. This comes as a crucial lifeline created during last year's banking crisis is set to expire. NYCB's shares plunged as much as 15% on pre-market trading after the downgrade before rebounding. The stock has plummeted roughly 60% in the past week after the lender reported dismal results, especially stemming from its exposure to souring commercial real estate loans. Last year, NYCB won the bidding for assets tied to Signature Bank, which failed shortly after the demise of Silicon Valley Bank. That pushed its assets above $100 billion, putting it into a new regulatory category and subjecting it to more stringent capital requirements. The KBW Nasdaq Regional Bank Index, a collection of mid-size bank stocks, has fallen nearly 12% in the past week as investors worry about lenders' exposure to commercial real estate loan portfolios. Let me go back. The shift in working practices after the height of the coronavirus pandemic has roiled the commercial real estate market, and lenders could face a maturity wall of as much as $1.5 trillion in commercial real estate loans set to come this year and next. The U.S. regional banks provide the bulk of such loans, putting them at particular risk. So this goes back to what I was saying earlier, that the coronavirus created a whole new environment for how people are working. They're not going into offices anymore. I would even stipulate, it's not just offices where people are going in and they're working for whatever corporation. I would argue stores, department stores that would normally have a department store in Manhattan is now decided to use websites like Facebook Marketplace. They're deciding to use TikTok, and they're selling online. They're selling on their websites instead of using a big department store. So it's what they call direct to consumer. And that has been stressed lately. I was just watching CNBC has an interesting report on direct to consumer, which has been a little bit iffy, Carvana being one of them. But I think that, the when you do a cost benefit, I think people are much more interested in staying, keeping their businesses at home or remotely into areas where commercial real estate costs less, and then just mailing their products out and that sort of thing. But so the timing couldn't be worse, because there is a loan program that came out based last year, like I was saying, on distressed banks, that the government put out and that loan is coming to an end. So, again, this is from the same New York Times article. On March 11th, the Fed's Bank Term Funding Program will stop making especially low interest loans to distressed lenders. Again, this is a program that was there to help distressed lenders, banks, from going under by providing low interest loans. The program was established last year amid the collapse of Silicon Valley Bank to help lenders shore up their finances on the cheap and restore the public's confidence in the wider banking system. The sinking share prices suggest that the investors aren't buying that message. Shares in Japan's Azora Bank and Switzerland's Julius Baer have sunk in recent weeks after both disclosed risks from the souring commercial real estate loans. Meanwhile, other European banks, including Banco Santander and Deutsche Bank, increased their exposure to the $6 trillion U.S. real estate debt market in the first half of last year, despite concerns about the tsunami of bad loans on the horizon, according to S&P Global. So this is an interesting thing, and I'm going to get into this in more detail later on. This phenomena of people using buying up bad loans and making money off of it, and it is an interesting way for folks to make money, for investors to make money, because if you buy a distressed asset, which is what a bad loan is, a distressed asset, you could make a ton of money if you can get it backstopped. Remember, as I indicated earlier, in China, they're not backstopping these bad loans. They're allowing these companies to be liquidated and, pennies on the dollar. So it's a risky bet, but there is a case where I believe that people will be making a lot of money off of a distressed asset, and I'm going to talk about that at the end of the show. But before we get to that, it's worth remembering, when this is from PBS, a reminder of what happened 15 years ago, when the economy imploded and the Great Recession, what would become the Great Recession, happened. At the time, 15 years ago, we thought we were going to go into a Great Depression because banks and lending institutions were falling apart, as well as other businesses. Remember, insurance agencies. Remember, these loans were backstopped by insurers to guarantee that these loans could be protected. Right? They had AAA bonds. They were AAA rated. So the entire system had come apart because of this issue with the non-commercial or the non-commercial housing market. Now this is commercial housing market that's going that is distressed. And I just want to play this video. This is from PBS. It's about 15 minutes, and it's important to remember where we were at.
Events in generations with huge consequences for the American economy and households throughout the country. This was the time a decade ago when the financial crisis erupted, a crash that most experts did not foresee. Its effects and of the recession that followed on income, wealth, inequality, and our politics are still with us. Tonight, our economics correspondent Paul Solman revisits how it all went down and the impact today of decisions made then. It's part of our weekly series, Making Sense.
So this is where, in some sense, the crisis began.
Yeah, this was the place where people were stumbling out of offices on the 15th of September 2008, the world having ended.
The Midtown Manhattan headquarters of Lehman Brothers, whose collapse 10 years ago this week was the signal event of the 2008 financial crisis.
It started in real estate, and it started with subprime, and that's the story everyone knows. How does that crisis in the suburbs of America move all the way back to the center of finance in New York?
Okay, how does it?
Banks are fragile things. Classically, we think of them as funded by deposits, with households putting their savings into the bank, and then the householders begin to get panicked and take all their money out.
But, says economist and historian Adam Tooze, author of the new book Crashed,
banks like Lehman don't have deposits. What they do is borrow money from other banks, and that money runs faster than any depositor can run.
So subprime mortgages begin to default. Lots of people are invested in those mortgages. Banks have a big stake. And so suddenly when banks look vulnerable, then they don't lend to each other anymore. Investors pull back. That's what happened?
Yeah, that's the crucial thing. Afterwards, there was a congressional inquiry that went after the banks for selling the bad securities to investors who've ended up being ripped off. That wasn't, in fact, the dangerous bit. The real problem were the bad debts, the securities that America's banks kept on their balance sheets.
In other words, Lehman not only created debt securities, bonds, backed by iffy subprime mortgages, it held on to them. When the debt started going bad, faith in Lehman collapsed. No faith, no credit, no Lehman.
We came as close as we have ever come in history to a total cardiac arrest, not just of the American economy, but the entire world economy.
Meaning everybody's afraid to lend to everybody else. Credit simply freezes, and an economy, a modern economy, can't function that way?
A modern economy can't function without credit for more than even a couple of hours, frankly, seconds. GE, the pillar of American manufacturing, was having a hard time getting short-term credit. So was Harvard University. Wage bills were not being paid.
And soon enough, the whole world was watching and enmeshed.
To illustrate your point about how the crisis spread globally, I thought we'd go to a Greek food stand, but you said, no, an Irish pub, and lo and behold, there's one right across the street from the old Lehman.
Yeah, because 2008 is all about banks, and the failure of the Irish banks in September 2008 is really the moment when the panic spreads to Europe in a way that the European states ultimately find almost impossible to handle.
Because European banks have a stake in Irish banks?
All of Europe is tied up with the Irish banking boom, is using Dublin as an offshore financial centre, and Dublin finds itself in the position on the 29th of September of having to guarantee the entire balance sheet of the Irish banking system.
Back in the US of A, September 29th was also the day Congress rejected President Bush's bailout bill.
The motion is not adopted.
And the Dow fell a record 777 points.
This is where the crisis goes from being a banking crisis to a crisis of the American economy as a whole, with stock market values crashing in September 2008.
We were now in the belly of the beast.
So here we have Wall Street with all the global banks. And then over here, the New York Stock Exchange.
Which is where we are now.
Which is where we are now. And the heart of the crisis-fighting effort, the Federal Reserve Bank of New York.
Ground Zero 929, the New York Fed. Here is where the system was saved.
And what the New York Fed decided to do, what the United States Federal Reserve System decided to do, was play the classic role it was always intended to play, to be the lender of last resort to American financial institutions.
Yeah, there's a lot of emphasis, for obvious reasons, on the unconventional side of Fed policy in 2008. The bailouts, taking equity stakes in banks, or quantitative easing. But what really made the difference in the survival of the American and the global banking system in September 2008 was indeed liquidity provision, to take an asset which is very unattractive to sell in the moment of the crisis because its value may be suspect.
Assets like loans backed by failing mortgages, which the Fed took off the hands of the banks.
And to give you in exchange a cash loan that will tide you over for a matter of days, weeks, or months.
Ready cash, liquidity.
And this saved the American financial system.
And this didn't just save the American financial system, it saved the financial system of the world. More than half of the liquidity provision to large banks in the United States was to European banks in the United States. And then on top of that, the Fed lent $4.5 trillion to European and Asian central banks, who indirectly provided dollars to their local banks in Europe and in Japan.
And this, says Adam Tooze, is the key to understanding the crash of 2008. A global financial crisis because of global financial interconnectedness. A crisis that would have been far worse had the U.S. not dispensed dollars worldwide.
Wall Street is a global banking center, so you have banks from all over the world, and the Fed is providing them liquidity not out of the goodness of its heart, but to stabilize the American financial system, to stabilize the American housing market.
And to stabilize the intricately interconnected global financial system, with players like Barclays of London, which bought the remains of Lehman.
Yes, Barclays got hundreds of billions in liquidity too.
So in the end, the system worked, right? I mean, we're on Wall Street, stock market, almost double what it was before the crash now.
Well, it did if you happen to be one of the minority of Americans who actually has stock, and most Americans don't. And large parts of America have not recovered from the crisis. The San Francisco Fed was estimating that as a result of the lost growth in the US economy, the decade in which America grew below where it might otherwise have been, the recession probably cost the average American about $70,000.
$70,000 in lifetime income, that is.
So that is not something we're ever going to get back, regardless of what happens in the stock market.
Which prompted a final question about the political ramifications of the crash of '08 at a final location.
This is Zuccotti Park, just by Wall Street, the site of the famous encampment from 2011 that spawned Occupy and the discourse of the 1% against the 99%, the place where inequality in America today was really put back on the political map. Huge rage against bailing out the banks. And the other great political reaction to the crisis came 2 years earlier in the form of the Tea Party, the idea that irresponsible borrowers who'd taken on debts they couldn't afford were now going to be rescued by the federal government. One opens, if you like, the door to a more radical politics on the right. The other opens the door to a more radical politics on the left.
Which is, of course, just where we are on the 10th anniversary of the crash of '08. For the PBS NewsHour, this is economics correspondent Paul Solman reporting from New York.
So while I really like that reporting, I would disagree that the Tea Party was created by by the whole Lehman, all of that kind of business. That is not why the Tea Party was created. Tea Party was created because of Barack Obama. It was very nativist in nature. So, but that's for another time. So, that is what I think is happening on the real estate, on the commercial real estate. I think it's going to metastasize. Banks, look out for banks. Look out for what's happening. And why is this important to you? Why do I want to highlight this whole situation? Number one is, if you are an investor, I'm not an investment professional and I don't give out investment advice. However, I just want you to make you aware of, if you are invested heavily in commercial real estate, I would speak to my financial advisor and think strongly about maybe moving your money elsewhere, because there could be something bad going along. Conversely, if you are somebody who is in this area and you are looking at ways to make some money, Michael Burry became a multi-millionaire shorting these kinds of stocks. So it's something to take a look at, what businesses are invested in this area. And, if you know what you're doing, you could probably make a lot of money on what could be coming if the banking industry or the commercial real estate industry, or both, begin to show signs of wear. Shorting some of these stocks, or pulling your money out and moving it into other areas, both banking and in the commercial real estate, might be something that you might consider. Again, I don't give advice. I don't give financial advice. You should get a financial advisor, but it's just something that you might want to think about.